On March 9, 2009, the S&P 500 closed at just 676 points. The global financial system was collapsing in real time. 6 months earlier, Lehman Brothers had filed for bankruptcy. Retirement accounts across the country had been slashed in half. Every headline warned about the worst economic crisis since the Great Depression. Fear dominated everything. Most Americans were doing the only thing that seemed rational at the time, pulling their money out of the market. But a school teacher named Margaret made a decision that many people around her thought was reckless. Instead of waiting for things to calm down, she took the $50,000 she had saved for a house down payment and invested it into a simple S&P 500 index fund. Her friends told her she was crazy. Her family urged her to wait until the economy stabilized. Margaret ignored all of them. Today, that $50,000 investment is worth roughly $590,000. She didn't pick winning stocks. She didn't perfectly time the market. She didn't have insider knowledge. What she had was something far more powerful. She recognized that moments of extreme fear sometimes create the greatest financial opportunities. Moments that appear maybe once or twice in an entire generation. Moments when panic pushes prices so low that ordinary people suddenly have the chance to build extraordinary wealth. And here's the surprising part. Most people don't realize we may be living through another moment like that right now. Not because markets have crashed, but because a different kind of financial shift is already underway. A convergence of forces that hasn't happened in nearly a century. Forces that will move more wealth into the hands of everyday people than any event in modern American history. The number is $124 trillion. And no, that's not a typo. Over the next 2 decades, roughly $124 trillion will change hands. Yet most people have no idea it's happening, or how to position themselves to benefit from it. In this video, I'm going to show you exactly what's unfolding, why the conditions today closely resemble past wealth creation moments that produced millions of new millionaires, and the practical steps ordinary people are taking right now to make sure they're on the receiving side of this historic shift. Because the story of what happened after March 2009 reveals something extremely important about how wealth is actually built. The S&P 500 didn't just recover from the 2009 crash, it began the longest bull market in American history. From March 2009 through January 2026, the market climbed more than 900%. Recently, the index even crossed 7,000 points for the first time ever. An investment of just $100 at the market bottom eventually became roughly $1,000. But the people who benefited the most weren't Wall Street professionals or hedge fund managers. They were teachers, nurses, accountants, small business owners, regular people who simply kept investing through their 401ks and IRAs while everyone else panicked. And the data behind this transformation is remarkable. In 2010, the United States had around 8.4 million millionaire households. By the end of 2024, that number had surged to nearly 24 million. In just 14 years, the country added more than 15 million new millionaire households. Think about that for a moment. 15 million households crossed the $1 million mark in less than a decade and a half. That's roughly the entire population of the New York metropolitan area suddenly becoming millionaires. So where did all of these new millionaires come from? Most of them didn't build billion-dollar companies. They didn't receive massive stock option packages. They were everyday people who simply participated in the long rise of the market through retirement accounts and index funds. According to UBS's Global Wealth Report released in 2025, the United States added 379,000 new millionaires in 2024 alone. That's more than 1,000 new millionaires every single day. And most of them didn't get there through sudden windfalls. They built wealth gradually as their investments grew alongside the market. UBS refers to many of these individuals as everyday millionaires, or EMIs. People with net worth between $1 million and $5 million. Globally, the number of EMIs has exploded. Since 2000, this group has quadrupled to roughly 52 million people. Together, they control more than $17 trillion in wealth. The path that created these everyday millionaires isn't hidden. It's well documented, it's repeatable, and the conditions that helped create them may soon become even more powerful. Because what's happening today could be even bigger than the opportunity that appeared in 2009. It's something economists call the Great Wealth Transfer. According to research from Cerulli Associates published in 2025, roughly $124 trillion in assets will pass from one generation to the next between now and 2048. This is the largest wealth transfer in human history. Nothing else recorded in modern economics even comes close. To understand the scale, consider this. $124 trillion is larger than the total annual economic output of every country on Earth combined. It's also more than 5 times the current U.S. national debt. This $124 trillion represents wealth built over nearly 8 decades of American economic expansion, and it's now beginning to move from one generation to the next. The mechanics of this shift are simple, but the consequences could be enormous. Baby boomers, the generation born between 1946 and 1964, currently control about 52% of all wealth in the United States. That's roughly $78 trillion concentrated in a single generation. The youngest boomers are turning 62 this year. The oldest are approaching 80. Over the next 20 years, much of that wealth will begin moving to their children, grandchildren, and charitable foundations. Cerulli estimates that around $16 trillion will go directly to heirs, while another $18 trillion will flow to charitable organizations. Generation X is expected to inherit roughly $39 trillion over the next 25 years. Millennials are projected to receive an even larger share, approximately $46 trillion. And even Generation Z will begin seeing meaningful inheritances as the transfer accelerates through the 2030s and 2040s. The timing of this shift matters more than most people realize. Generation X, often described as the forgotten generation, is expected to receive about $1.4 trillion every year over the next decade. For many Gen X households, this money will arrive during one of the most financially stressful periods of life. They're often caring for aging parents while still supporting children of their own. For some, this inheritance wave could dramatically change retirement plans that currently look uncertain. Millennials will likely wait longer, but the potential impact could be even larger. The $46 trillion expected to reach this generation will arrive just as many millennials enter their peak earning years. That creates a powerful combination, inherited capital growing alongside rising career income. But there's one critical detail that most coverage completely overlooks. The opportunity created by this wealth transfer isn't only about inheritance, it's about what happens when that much money begins moving through the entire economy. When $124 trillion changes hands, it doesn't remain idle. It gets invested. It gets spent. It gets directed into businesses, real estate, and financial markets. Every dollar that moves creates new opportunities for the people positioned to capture a small part of that flow. The last time something remotely similar occurred was after World War II. Millions of returning soldiers used the GI Bill to buy homes, start businesses, and build what eventually became the modern American middle class. That era of economic expansion helped create the baby boomer generation, the same generation now preparing to pass on its wealth. In many ways, history is repeating itself, but this time, the scale is far larger. The similarities to 2009 also run deeper than most people realize. Back then, 3 key conditions aligned to create enormous wealth-building opportunities. First, assets were heavily undervalued after the stock market had fallen 57% from its peak. Second, massive amounts of capital were injected into the economy through stimulus programs and quantitative easing. And third, most people were too afraid or financially unable to take advantage of the opportunity. Today's situation looks different on the surface. Markets haven't collapsed, but a different kind of financial shift is beginning to take place. The great wealth transfer will create both opportunities and disruptions. Some assets will be sold as estates are settled. Other assets will be reinvested by heirs who have very different investment preferences than the generation before them. This constant movement of capital will create buying opportunities for investors who are prepared. And unlike 2009, the capital injection this time isn't coming from governments. It's coming from the wealthiest generation in modern history transferring assets to their children. The scale is enormous. At $124 trillion, this wealth transfer is larger than any stimulus program governments have ever attempted. To put that in perspective, the entire global pandemic relief effort totaled about $5 trillion. The great wealth transfer represents roughly 25 times that amount flowing through the economy over the next 2 decades. And yet, just like in 2009, most people aren't paying attention. Daily market headlines receive far more attention than this long-term shift, even though its economic impact could be far more significant over the next 20 years. The people who became millionaires after 2009 weren't necessarily smarter than everyone else. They simply recognized an opportunity and were positioned to take advantage of it. The same principle applies today. But benefiting from this moment requires understanding a few key dynamics. The first is that inheritances alone will not create most new millionaires. That may sound surprising given the enormous numbers involved, but when you look closely at the math, a different picture emerges. Cerulli estimates that roughly 62% of the wealth being transferred will come from high net worth and ultra-high net worth households, but those households represent only about 2% of the population. In other words, the wealth transfer is extremely concentrated. A relatively small number of families will inherit enormous fortunes. Most families will receive far smaller amounts, and many will receive nothing at all, which leads to an important conclusion. Depending on inheritance alone is not a reliable strategy for building wealth. For most people, life-changing inheritances simply won't arrive. What they will experience, however, is something far more widespread. An economy being energized by $124 trillion of capital in motion. The real opportunity isn't the inheritance itself. It's the economic ripple effects created when that much money begins moving through the system. Think about what happens when trillions of dollars shift from one generation to another. When large amounts of money flow into investment accounts, asset prices tend to rise, benefiting anyone who is already invested. When heirs begin buying homes, real estate values increase, benefiting existing homeowners. When inherited wealth funds new businesses, job creation expands, benefiting workers across the entire economy. In other words, the wealth transfer lifts multiple asset classes at the same time. The rising tide extends far beyond the families directly receiving inheritances. The second important dynamic is understanding where that money will flow, because the next generation invests very differently from the one before it. Research from Bank of America and Merrill Lynch shows that younger investors have dramatically different investment preferences compared to baby boomers. According to their survey, 72% of investors between the ages of 21 and 43 believe it's no longer possible to achieve above-average returns using only traditional stocks and bonds. That belief represents a major generational shift in investment thinking, and when trillions of dollars move into the hands of people with different financial preferences, capital begins flowing into different sectors. Baby boomers tended to favor blue-chip stocks, bonds, and traditional portfolios. Their heirs are showing stronger interest in alternative investments, private companies, and emerging asset classes. Over time, this shift could redirect massive amounts of capital. Industries aligned with younger investors' interests may see enormous investment inflows over the next several decades. Artificial intelligence infrastructure is already attracting huge amounts of capital in 2026, with companies like NVIDIA driving significant market gains. At the same time, sectors like clean energy, healthcare innovation, and digital assets are increasingly attracting younger investors. This doesn't mean traditional investments will disappear, but it does mean that capital flows are changing, and investors who recognize those shifts early may be able to position themselves more effectively. Sectors that benefited from decades of boomer investment could eventually underperform compared to industries attracting millennial and Gen Z capital. The third major factor involves real estate. Housing markets may experience some of the most visible changes during the wealth transfer, but those changes won't occur evenly across the country. In some areas, demand will increase dramatically as wealthier heirs begin purchasing homes. In other places, supply may rise as inherited properties come onto the market. Regions where baby boomers concentrated, particularly suburban areas and retirement destinations, may see rising housing inventory as properties pass to the next generation. Meanwhile, cities and regions where younger professionals want to live could see even stronger competition for housing. We're already seeing early signs of this shift. Since the year 2000, median home prices in the United States have increased by more than 150%. But that growth has been extremely uneven across different regions. Cities attracting young workers and technology investment have significantly outperformed areas experiencing population decline. And over the next 2 decades, location could matter even more. The same $500,000 investment in housing could produce dramatically different results depending on where it's placed. A home in Austin may follow a very different trajectory than a home in Cleveland. Geography, in other words, becomes a powerful factor in long-term wealth building. The fourth principle is much simpler, but equally important. Stay invested. The school teacher Margaret, who invested $50,000 during the depths of the 2009 crash, didn't rely on complicated strategies. She needed only two things: capital to invest, and the discipline to remain invested through uncertainty. Historically, the stock market has delivered average annual returns of roughly 10% over long periods. Someone who began investing $500 per month into an S&P 500 index fund in 2009 would have accumulated more than $250,000 by early 2026, even without counting any employer matching contributions. But that journey wasn't easy. Along the way came several moments when the future of the market seemed deeply uncertain. The European debt crisis in 2011, the government shutdown in 2013, the trade war in 2018, the pandemic crash in 2020, and the bear market of 2022. Each time, headlines warned that the market's rise was finally coming to an end. At every one of those moments, investors who stayed in the market eventually benefited from the recovery that followed. The great wealth transfer will certainly create new opportunities, but the most dependable path to building wealth will remain what it has always been: consistent investment in diversified assets over long periods of time. What the transfer does is add a powerful tailwind to a strategy that has already worked for generations. One thing people often misunderstand about major wealth-building periods is how they actually feel while they're happening. Looking back, the years after 2009 appear almost like a golden era for investors. But while it was unfolding, it didn't feel that way at all. There was always another reason to worry, another crisis, another headline predicting the end of the market rally. And yet, despite all the uncertainty, the market kept rising. The S&P 500 crossed 2,000 in 2014, then 3,000 in 2019, 4,000 in 2021, 5,000 in early 2024, 6,000 later that same year, and by January 2026, it had crossed 7,000. Investors who remained patient through all that uncertainty steadily built wealth. Those who repeatedly moved their money to the sidelines often missed the largest gains. Research from Goldman Sachs highlights just how costly that can be. Missing only the 10 best days in the market since 2009 would reduce annual returns from roughly 17% to around 12%. Miss the 25 best days, and overall returns are cut almost in half. What makes this even more difficult is that the market's best days often occur during its most chaotic moments, when fear is highest and many investors are tempted to sell. The great wealth transfer will likely follow a similar pattern. There will be recessions, market corrections, periods of economic stress. Headlines will regularly claim that this time is different, that the old rules no longer apply. But history suggests those warnings are often temporary, because beneath the short-term volatility, one powerful force will continue shaping the economy. $124 trillion looking for productive places to go. That level of capital movement will continue creating opportunities regardless of short-term market noise. We can better understand the impact by looking at a simple example. Imagine a 35-year-old investor today contributing $500 per month into diversified index funds over the next 25 years, roughly the length of the wealth transfer period. Over those 25 years, the total contributions would equal about $150,000. If the market delivered its historical average return of around 10% per year, that investment could grow to approximately $665,000. Even with a more conservative 7% annual return, the final value would still reach roughly $405,000. But if the additional capital flowing through the economy increases long-term growth by even a single percentage point, the numbers change meaningfully. A 7% return becomes 8%, and that same $405,000 grows closer to $475,000. Now imagine increasing the monthly contribution to $1,000, something that becomes possible for many people as their careers progress. At a 10% return, that portfolio could grow to around $1.33 million over the same 25-year period. This is how many ordinary investors eventually reach millionaire status. Not through sudden windfalls, but through consistency. At first glance, these numbers may seem abstract, but in reality they represent something very tangible: the difference between financial security and financial stress later in life. And the great wealth transfer may make outcomes like this more attainable for a larger number of people. The fifth opportunity created by this shift involves entire industries that will grow as wealth moves between generations. When $124 trillion changes hands, a vast network of professionals is required to manage the transition. Financial planners, estate attorneys, tax advisors, wealth managers, legal specialists. All of these fields are likely to expand significantly in the coming decades. Real estate transactions will increase. Estate planning activity will accelerate. Trust and inheritance disputes will likely become more common. For individuals who build expertise in these areas, the wealth transfer may create decades of strong demand. In other words, the benefits of this transition won't be limited to heirs alone. They will extend to the professionals responsible for managing, protecting, and allocating that wealth. And we are already beginning to see the early signs. The percentage of millennial and Gen Z clients at wealth management firms focused on high net worth individuals rose from just 8% in 2021 to 25% by 2024. Advisors who understand the priorities of younger investors are rapidly building client bases that could last for decades. The sixth dynamic involves a stage of the wealth transfer that receives far less attention. Before much of the wealth passes to the next generation, a large portion will first move between spouses. Cerulli estimates that roughly $54 trillion will initially transfer to surviving spouses, and nearly $40 trillion of that will go to widowed women. This shift will dramatically increase the number of women managing substantial wealth. As a result, the financial services industry is already recognizing a rapidly growing market for advice, planning, and wealth management tailored specifically for women. Advisors, planners, and wealth managers who specialize in serving this growing demographic will likely see enormous demand in the coming years as women increasingly become the primary decision makers over large amounts of wealth. But the full impact of this transition won't happen overnight. The great wealth transfer will unfold gradually over several decades. It's not a sudden event. It's a long process, more like a marathon than a sprint, and the people who begin positioning themselves early will benefit from compounding advantages throughout that entire period. One question always comes up when discussing opportunities like this. People want to know the perfect time to invest. They imagine there must be a single moment, a clear bottom, that signals the ideal entry point. Looking back, the market bottom in 2009 now appears obvious, but at the time it didn't feel obvious at all. Many investors believed the market could fall much further, and plenty of experts expected exactly that. The difference today is that the great wealth transfer doesn't have a single moment to time. There is no bottom. It's a multi-decade process that has already begun. The oldest baby boomers are now 79 years old in 2026. That means wealth transfers are already taking place. Every year that passes, more capital begins moving to the next generation. Waiting for the perfect moment to act simply means missing valuable years of compounding while this transition continues. There's a well-known saying that captures this idea perfectly. The best time to plant a tree was 20 years ago. The second best time is today. The same logic applies to positioning yourself for the great wealth transfer. What's especially striking about both the opportunity in 2009 and the opportunity today is how visible the information actually is. There are no hidden secrets, no exclusive knowledge reserved for insiders. In 2009, the market collapse was visible to anyone with access to a brokerage account. And today, the $124 trillion wealth transfer is documented in publicly available research reports that anyone can read. Yet in both situations, most people failed to act. Back in 2009, fear prevented investors from taking advantage of the opportunity. Today, the obstacle is different. Instead of fear, it's distraction. Short-term thinking, and the difficulty of focusing on an event that will unfold over decades rather than months. But the individuals who benefited most from the post-2009 market recovery weren't unusually lucky. They simply took action based on information that was available to everyone, and the same will likely be true for those who benefit most from the great wealth transfer. So what does positioning yourself for this moment actually look like? Based on the research, several practical strategies stand out. The first is maximizing contributions to tax-advantaged investment accounts. As trillions of dollars move through the economy, individuals whose retirement accounts grow alongside that expansion will capture part of that growth. That means taking full advantage of vehicles like 401ks and IRAs. If you qualify, health savings accounts can also be extremely powerful tools. These accounts allow investments to compound year after year without being reduced by annual taxes. For 2026, the contribution limit for a 401k is $23,500, with an additional $7,500 catch-up contribution available for individuals over 50. The second strategy is maintaining broad exposure to the equity markets. Rather than trying to predict exactly which sectors will benefit the most, many investors simply focus on owning the entire market through low-cost index funds. As the wealth transfer pushes capital into different industries and assets, broad exposure ensures participation in the overall growth of the economy. Another opportunity involves developing skills connected to the movement of wealth itself. Careers and side businesses in areas like finance, estate planning, real estate, or wealth advisory are directly tied to the management and allocation of capital. As trillions of dollars begin shifting hands, expertise in these fields could become increasingly valuable. It's also wise to maintain some level of cash reserves. During large financial transitions, markets occasionally experience temporary disruptions. Assets may become mispriced during periods of uncertainty. Investors who have capital available during these moments can sometimes take advantage of opportunities that others miss. Time horizon also plays an important role. The great wealth transfer will unfold over roughly 25 years. Which means thinking in decades rather than months becomes essential. Short-term market movements may feel dramatic, but long-term participation in economic growth is far more important. Location may also matter. If you have flexibility in where you live or invest, it's worth studying where wealth is likely to concentrate and where it may disperse. Real estate markets receiving new inflows of wealth could outperform those experiencing capital outflows. Finally, conversations within families can also play an important role. Understanding family plans around inheritance or estate planning can help individuals make more informed financial decisions. Whether you expect to receive wealth or eventually pass it on, thoughtful planning can ensure transfers happen as efficiently as possible. Looking at history helps place the current moment into perspective. The United States has experienced several periods where economic expansion created large numbers of new millionaires. After the Civil War, rapid industrial growth produced the first generation of American millionaires, though most of that wealth remained concentrated among industrialists and financiers. By the year 1900, the country had only around 4,000 to 5,000 millionaires. The next major expansion occurred after World War II. Rising home ownership, stock market participation, and employer pension systems helped create the first widespread middle-class wealth in American history. Home prices alone have increased roughly 500% since the early 1980s, when many baby boomers were first entering the housing market. The bull market that ran from 1982 through 2000 created millions of new millionaires as 401k plans expanded and technology companies fueled a massive surge in stock prices. Since the early 1980s, the S&P 500 has increased by nearly 3,000%. Then came another extraordinary period of wealth creation. From 2009 through 2026, the market recovery helped nearly triple the number of millionaire households as stock prices climbed to record levels. When the S&P 500 crossed 7,000 in January 2026, it marked yet another milestone in one of the longest periods of economic expansion in modern history. And the pattern behind these wealth-building eras is surprisingly simple. Each of these periods created millions of new millionaires, not because people discovered secret strategies, not because they had insider connections, but because they participated in long-term economic growth. No genius required, no special access, just patience and the willingness to stay invested. The great wealth transfer represents the next chapter in that story. Over the next 25 years, $124 trillion will move from one generation to another. As that capital circulates through the economy, business activity will expand. Asset prices will likely receive long-term support, and new opportunities will continue to appear. The real question isn't whether the wealth transfer will happen. That process is already underway. The real question is whether you'll be positioned to benefit from it. Back in 2009, the school teacher Margaret had no idea she was stepping into a once-in-a-generation opportunity. She didn't have perfect foresight. She simply recognized that fear had created value. And she acted. The opportunity today works differently, but the scale may be just as significant. Trillions of dollars are beginning to move through the economy. Over time, that movement will help create millions of new millionaires. Years from now, historians may look back on this period as another defining moment in wealth creation. And now you're aware of it. You know the scale of what's happening, you understand the timeline, and you've seen the strategies that allow ordinary people to participate. What you choose to do with that knowledge will determine whether you're among the millions who eventually look back on this moment as the turning point that changed everything.